Hello, everyone. Welcome to Multifamily Investing Naked Truth. This will be episode 9. I have Christian Szpilfogel from Ottawa, Ontario, joining us today. He is the founder of Aliferous group of companies. Hopefully I got that right. Welcome to the show, Christian.
Thanks. How are you, Corey? You're sunning it in Kelowna today?
We're sunning it, and we were just discussing the extreme cold wave that's going on in Southern Ontario right now. I'm seeing photos in Ottawa and Toronto minus 20s. I'm guessing you guys don't see that kind of weather very often.
Well, we're in Ottawa, of course, is in Eastern Ontario. We try to dissociate ourselves from the Southern Ontarians.
Okay.
But we do routinely get cold weather about this time of year. End of January, beginning of Feb is the coldest time of year for us. And we had minus 30 before the wind chill late last week. And as I was mentioning to you, we had a couple of HVAC units pack it in Friday morning. They just couldn't take it. And so we had some emergency repairs to do.
Yikes. Life as a property owner. So I'm super stoked to have you on this show. I've heard a lot of your interviews and podcasts, and I can say I'm very impressed. You're one of the only people I've known in 23 years of investing. Investing is your full-time gig. This is your full-time job. Mm-hmm. You're not a real estate agent. You're not a property manager. Is that correct?
That's correct. I kind of refer to it as I graduated from full-time employment to being an investor now. But yeah, no, this is all we do. It's a family-run business. We're self-capitalized, so it's kind of unusual that people come onto these podcasts and I have no ask. I'm not asking anybody for money. I don't care about that. Right? We're all on our own here. So, but yeah, we're a family-run business, and we invest primarily in various forms of real estate, but we also invest in tech angel funding as well, which it allows me to have a little bit of my, live vicariously through others in their tech entrepreneurship.
Awesome. Good stuff. Like self-capitalized is important. I've interviewed a couple people who are self-capitalized in real estate with multifamily in particular. I don't see it happen very often. So the fact that you're able to do that, obviously you're able to have enough positive cash flow that you could leave your employment and do this full time, which is not something that very many people can do. Most of the time in multis, people do it as a side hustle, whether it's multi or single family. Most investors that I know, probably 99%, it's a side hustle. So you've actually taken it one step further. Now, this show is going to be a little bit more advanced from what my audience is used to. We're going to be talking about different metrics and stuff. I just love the way you explain things. But before we dig into it, Christian, you mentioned tech. I want to just go back a little bit. I understand that you have a tech background. That was kind of how you got started, right? Your first career, correct?
Yeah, that's right. I actually have my background is just very diverse, right? And I think it's prepared me for, the business that is real estate investing. I actually started with my underdegree in physics, and I did then went into technology and was part of a variety of different technology firms. Did a number of roles, everything from research and development to product management, to chief architect to general manager, that kind of stuff. So it's fairly diverse background. And I just, as a friend of mine who's quite a large tech entrepreneur says, because he actually makes most of his money in real estate. And he said, but for fun, he does the technology piece, and he literally has founded hundreds of companies. So I understand that, I still get involved in technology, and that's why we do some of the angel funding on that side. I have very low expectations of a decent return, right? But it's maybe a bit more giving back, and every once in a while you get lucky and something works. So.
Fabulous. No, I like, the angel funding. That's something that I hope to get into. I mean, I have a couple of, penny stocks and potash in my TFSA, but I don't think I can include that as an angel startup where, I mean, your returns could essentially be 100 to 1 or 1,000 to 1 or higher, if you hit it out of the park, but obviously you're not expecting that.
No, usually the timeline for stuff like this is about 10 years. So the money put in, you kind of hope that you'll get some form of a payout in 10 years. And some companies never make it, and some companies get acquired and consumed by others, and you get some amount of equity that comes with it. And then others turn into home runs. And as you say, you might get like 10 to 1 or 100 to 1 on the money that you originally put in. So like I said, I'm doing better than my pessimistic assumptions. I'm actually doing quite well on it, but the time horizons are large, and I always set my expectations low, and that's why I'm always happily surprised when things do work out.
Yeah, no, that's awesome. So I want to just switch to real estate. I know, it's been said many times, all right? Levered real estate, is very usually skinny on cash flow. You're usually just making enough to pay your bills, but you've taken this business model and you've actually generated enough cash flow that you can pay yourself. It's a family business. I understand you also have staff, you have overhead, and you're able to do that strictly from the cash flow of your properties. So at what point in your career, when you were working maybe in IT, did you get the real estate bug and say, this is what I want to do full time? Like approximately how long ago was that?
Oh boy, probably back into the 90s. So my wife and I are both worked for private. Well, my wife was an independent contractor, and a lot of her jobs were government. But I worked for private firms all the time, and neither of us had a pension plan. So that was the first catalyst, was just say, well, we need to do something to prepare for retirement, because you never know if you might get incapacitated, unable to work, forced into early retirement, industry changes, anything can happen. So we knew we needed something else. And we were both interested intuitively towards real estate. I'd say the first thing that we did, not intentionally, we had other reasons for doing it, but we picked up a piece of land back in 1990. We held on to that. For probably about 7 or 8 years, we eventually sold that. And then we bought our first real investment property in 2005. So it took us a while before we actually pulled the trigger. And it was because until then we were primarily investing in our single family home, right? So where we were raising our family. So as come to discover, as you mature as an investor, you realize that money going into your single family home, the one that you live in, is not really much of an investment. It's really more of a way of storing money. So hedged against inflation is really what it is. But then this 4-unit building next door to our home, and as a purpose-built 4-unit apartment building, came up for sale, and we pulled the trigger on it. And that's where, because we were a single income family at the time, that's why we, I shouldn't say we, my wife is a big risk taker. Okay. So she was like, yeah, let's do it. And I said, okay, well, I got to make sure that we don't sink the family at the same time. So I spent a lot of time analyzing and making sure of exactly all my contingency planning in the event that we had 1 vacancy or 2 vacancies. So figured out what if, and at the time interest rates were at about 5.5% for a fixed rate. Okay, so sounds familiar now, doesn't it? But I checked to say, okay, well, what happens if it hits 7% or 10%? How long could I weather the storm? So I did a lot of risk planning around it, and that allowed me to figure out exactly the maximum I was prepared to pay and not put my family at risk. And that stood me well for the negotiation, because we ended up getting it for effectively the price that we wanted. And there's a whole other story behind that, but in the interest of time, I'll skip that. So that's really how we got started. And then, like you were describing at the beginning, I would have called ourselves hobby investors at the time. It was, picking up some assets, making sure that we had a soft landing for retirement. We weren't very efficient about it. We didn't completely understand how to really do it as a business. So we let equity build up. We refinanced stuff. We bought a 6-plex in 2010, which we later converted to a 9-plex. And that conversion is kind of where everything started to come together for us. Because when I did that 6 to 9 conversion, I discovered quickly, because that, of course, was my first commercial building too. And all I can say is the bank was incredibly patient with me when I was doing that acquisition. I had no idea what I was doing. So, but the bank kind of helped me through it, and that's a whole other story too. But in that conversion, when we did the 6 to 9, it suddenly occurred to me that, especially with commercial properties, where the valuation, as you know, Corey, is based on the net operating income. If I could find a way to change the net operating income, I could change the value of the building, and I could change the cash flow profile. And it was huge, right? It was an epiphany at the time, right? right? And so when I discovered that, I realized this is what we need to be doing, right, on all of our properties. And so that's really kind of, you know, how we got into it from there. And then, of course, after that, we started really educating ourselves, refining our skills, figuring out how to do it, everything a lot better, streamlining the operations, learning how to invest effectively and not do it in an over leveraged position. So, you know, often people say, you know, well, you got to maximize your leverage. I'm not in that camp at all. So, which might surprise you since we're self-capitalized.
Yeah, I know. I like what you've just said there, especially about the, you know, you've kind of taken the business model of repositioning, you know, looking at an asset and, you know, how can I change it? You know, and as we talked at the beginning of the conversation, an interview you did with Elizabeth on repositioning, Elizabeth Kelly, on, you can check out that one on YouTube, by the way, on repositioning a multi. And you had a couple of really impressive case studies on there. I mean, you had one that was, I believe it was 6 residential and a commercial and a house that you managed to negotiate with, you know, a crazy VTB of 90%. You know, you changed some things around, got the income up, got all of your equity out, essentially, you know, driving an infinite rate of return after that. But before we get into repositioning and your business model, I want to talk about inflation, because you mentioned that kind of at the beginning there, and it was your house was a hedge against inflation. Now, a piece that I took away from the interview you did with Elizabeth, and something I've heard before, but maybe I don't have a complete grasp of it. You know, you kind of said, you said inflation is your friend, right?
Mhm.
It makes debt cheaper. So in high inflation, you get cheap debt fast. So if inflation is running at 6% and your rates are only 3%, then you're essentially getting that 3% for free.
Yeah.
Do you want to kind of explain how that works?
Yeah, absolutely. Right. So there's a whole bunch of stuff mixed in there. So I'm just going to break it apart a little bit.
Yeah, sorry.
No, it's all good, right? Because I think it was a concise way of actually framing it. So the first thing to understand, and what people need to understand, is that the intrinsic value of the asset, if you do nothing to it, doesn't fundamentally change. A single family home is a single family home. In 10 years, it's still a single family home. It still houses a family. That's it. So it didn't fundamentally change. But what did change principally is the value of the money that was used to buy it.
Right.
And so in that time, through inflation, what's really happening is you're devaluing the currency. It's not so much about the increase of the value of the products. You know, a tin of beans is still a tin of beans. It is what it is, right? You still consume it the same way. But you have to use more money to buy it. So it was the money that got cheaper. And one analogy that I use at the beginning of the pandemic, when people were worried about inflation, I went to take a look as some proof points to show exactly what I was talking about. And one of the best ways to look at that is salaries. So I went back about 2,000 years, and a Roman centurion was paid, I believe it was around 38 ounces of gold annually. And then I looked around to a reasonably modern empire right now, or at least some, a nation with a strong military force of the same form. And, I used the United States, which seems reasonable. And then I said, okay, well, what's the equivalent of a Roman centurion is a US Army captain. And then 38 ounces of gold at that time, I think, was roughly $55,000, $60,000, which, as it turns out, almost coincidentally, if you will, is it ends up in the mid-range of a US Army captain's salary band.
Interesting.
Right? And so even if it was off a little bit, it just worked out really well that way. But, it could have fluctuated a little bit. And really what it demonstrates is the value of that person in that role is roughly the same as it was 2,000 years ago. Their compensation, gold, which is effectively a hedge against inflation, basically maintained the value of that. So real estate follows the same kind of principle. It is fundamentally a hedge against inflation. If we look at it across Canada-wide, you would see that it effectively increases at the rate of inflation. Now, there's some little quirks. For example, there's rural to urban migration, which increases the value of properties in urban, within the urban boundary. Some argue that there's a reversal of that because of the pandemic effect and remote working, but However we look at it, still fundamentally, that's the thing. So the value of the currency is the thing that's actually devaluing that scenario. So when we have high inflationary times, right, people get nervous about it because they're worried about their interest rates primarily. And so if that's what we're worried about, then we manage that risk. And so that's a piece that we do actively manage. It's one of the reasons that I'm a fan of fixed rate products. We don't use them exclusively, but we use fixed rate products a lot. And even I just look at it as an insurance premium. So it says, yep, interest rates could go up. So in order to protect ourselves from that, I'll buy a fixed rate product for a fixed period of time so that my cash flow is now predictable. I don't have to worry about what's happening with interest rates as a result of inflation. So that's the thing. So if you can get past that and you can manage that risk, if you do variable rate mortgages, you can manage the risk in a different way. You can have reserve funds. So you can have something to prepare in the event you guessed wrong about variable rate mortgages and it goes up. If you have, contingency funds, that's another way to mitigate that risk. So
commercial where they force you to go fixed rates. If you do variable, it's for a short-term time at the beginning of very high rates, whether it's mixed commercial or multifamily, you pretty much, you have to go fixed rate, correct?
Yeah, you do, because they're typically tied to the bond yield. You can get open
Right.
products and closed products. So, but yeah, typically commercial stuff is always in a fixed rate, but I have some other stuff, lines of credit, for example, that have variable rate components. So that's the main issue that people have. So if we can mitigate that risk, then the question comes back again to what's happening with inflation. So, if you have a single family home or you have a 100-unit apartment building, those assets didn't change in intrinsic value on their own, but the debt is getting cheaper and it's reducing your loan to value. And then later on, when you go to refinance something in 5 years, if inflation was particularly high, you've deleveraged significantly purely because of the inflation rate. So that's why when I take a look at inflation, when you have debt and assets, is a friend. Okay, so long as you manage it properly, it's actually a friend. Inflation is problematic for people who don't have any assets, right? And that's where the pain comes in. So when we worry about, the citizens of our country in a high inflationary time, it's the people who don't hold assets that are the most vulnerable in those scenarios because they rely completely on their salaries. But if you're holding assets and you're holding debt against that asset, you're actually in a preferential position.
As long as you don't over leverage, as you kind of alluded to, you keep a comfortable amount of leverage. I believe you keep around 65% in your portfolio, but you use debt to your advantage to hedge against inflation at a safe margin.
I do, right? So if someone chooses to go with a higher leverage, that's okay, but you need to have an exit that takes it back out. So you're either forcing the appreciation of an asset through repositioning, for example, or you're finding ways to otherwise deleverage it, or you have contingency funds in the event that you need to do that. So on any specific deal, I might be very high ratio, and that's okay because I have enough ballast in the portfolio that I'm maintaining, not more than 65% debt to asset ratio. To me, that's comfortable. Some would argue 75% is more efficient and suitably safe. I'm not on that page. I personally like to be a bit more conservative about it. And right now we're actually underweight. So we're probably only at about 45% debt to asset ratio. So
yeah, and you're okay in a rising interest rate environment as we are. So you got a little bit of cushion to play. So right now, I mean, we're in a high inflation environment. I'm not sure what the actual inflation is right now. I think it's like around 6%. I think the borrowing rate on a fixed rate, I think, is around 5-ish. So what would happen if, let's say, the government suddenly got their act together, inflation dropped back down to 2, but now our borrowing rate stays at 6? Is inflation then working against us, or are we taking a longer term view of it, like a 10 to 20 year horizon?
Yeah, well, again, if the interest rates are running high like that and your inflation is running at only 2%, then yeah, your cost of borrowed funds are effectively running you in a bit of a deficit. But again, this is why we tend to manage things too with particular fixed rates.
Right.
At the end of the day, the debt is still getting cheaper, even if the interest rate is running high. So that's why what we do is we'll fund the interest rate out of the cash flow of the asset itself. So
Right.
if we, because, what you're painting is the reverse of what you were introducing earlier, which is that,
Yes.
in that scenario where you have, effectively a high inflation rate and you're borrowing money at 3% and it's devaluing faster than the interest is covering, then absolutely the bank is giving you money every month, right? Inadvertently, but that's what's happening. So you're right in the opposite side. So, but the way that we manage that to begin with is, I don't look at it that way. I look at it as, okay, what is our debt servicing as a function of our net operating income, right? Which is pretty much the way a
Right.
financial institution will look at it. And do we have enough cash flow in order to pay for that interest? The inflation is reducing the debt at the same time. So the net cost is actually lower. So if it was a 2% inflation rate and we were doing roughly 6% interest, the net is a 4% cost to you.
Right.
So long as it's actually being funded out of the cash flow of your operations, then that's fine. What I see some people doing is they view their appreciation as a piggy bank, right? Where they'll do a refinance of that, and then that's what they're actually going to fund their operations in, or even potentially their income and salary. And to me, that's there's a lot of issues with that. Part of it is risk, part of it is tax liability related issues, but that's a whole other discussion.
This is golden, Christian, because there's so many. I just got the wheels turning with so many different things you've said, and the way I've run my business for the last 20 years. I mean, you've done a lot more of a deep dive. You do a lot more analysis, but the way you just explained inflation to me is not something that a lot of people talk about. We see it as the enemy and not necessarily our friend. And now I know inflation does tie in with your internal rate of return formula, the IRR, which I want to kind of segue into. So maybe we'll swing to multifamily a bit. And you talked about a few metrics. So just kind of a brief introduction for people, or I guess a review. So Christian mentioned the net operating income, which is like your gross income, which is your rents, your rent, your parking, your laundry, whatever. And then you have to subtract your vacancy, and then you subtract your expenses. So you're left with a net income before your mortgage payment.
Mhm.
And then you have your cash on cash, which I believe is once you subtract your mortgage payment and then divided by your original investment. I know you talked about quite a few of these metrics, cash on cash. And then there was also the DSCR, or the coverage, which is basically what the bank is looking for as terms of their margin of safety, right? I think so. You take your net income, you divide it by your total mortgage payments. Now, for me, what has drastically changed is I'm not so much looking at cap rate anymore, and we haven't even talked about cap yet, but loans are being scaled back because of debt service requirements, right? Like I have multis that I'm borrowing at 1.8, 1.9%, and now I'm looking at 4%. Well, the amount of money that they're willing to lend you has changed dramatically, and I'm sure you've seen that as well.
Oh, 100%. So in late last year, so one of my industrial properties, I needed to do a refinance on. We did a lot of appreciation on that building. That building is worth about, cheapers, 3.5 times what I bought it 4 or 5 years ago.
Wow.
And that's, people say, oh, well, that's just because of, housing prices went up. Well, no, this is an industrial property. So
Completely different ball game, completely different ball game.
Yeah, the only way that goes up in values is you increase the NOI. That's it. So I had refis to do, and it was interesting. The bank that had the loan on that originally was CIBC. CIBC said, yeah, we'll renew the loan, but we're not going to do any equity takeout. And I said, pardon? They said, we're not doing any equity takeout. I said, me specifically, or is this just a blanket statement? And they said, nope, it's a blanket statement. We're not doing any equity takeout in the commercial space, in this particular space. right? And I've always known that banks have, asset classes that they prioritize and deprioritize, right? Normally,
Yeah.
and I've seen that before with TD as well, but it just kind of surprised me a little bit. It said, really? There's a lot of money in here for you, right? So, but they said, no, not interested. I was like, okay. So TD, on the other hand, was extremely aggressive about winning the business. Went to my mortgage brokers as well. The mortgage brokers couldn't do anything for it. So at the end we did it with TD. So we did a pretty big equity takeout on that. So where's that all going? It comes back to your question of how much equity were we able to take out? Well, obviously the debt service ratio was was the bound on that, right? And where,
Yep.
Like on a multifamily, if we were doing a multifamily, with CMHC, the theoretical limit with the traditional product is about 85% loan to value.
Yeah.
And for the uninitiated, CMHC is an insurance product that Canada Mortgage and Housing Corporation offers to the banks. So that the banks can underwrite it when basically their money is guaranteed. So the interest rates are lower, the amortizations are longer, et cetera. So theoretically, you could get an 85% loan to value, but practically speaking, with interest rates where they were in the back end of next year, you might only get about maybe 60% loan to value, right? And some of them were at 55% loan to value. You sit there and you think, well, do I just wait this out, or do I lock it in? And so I decided to move forward with equity takeouts on a bunch of buildings. So 3 multifamilies in that industrial building, plus I increased our lines of credit as well, just because I see several things potentially happening. And I apologize for the segue, Corey, right? But
No, this is exactly what I wanted to ask you. You're actually segueing right into my next question, is what you're doing with your business. So you're painting a very good picture of that.
well, I'll pause it after I get to the objectives, but I kind of view that we're in uncertain times. Okay, so a lot of people are making predictions about things like interest rates coming down, recessions happening, etc. I would say that our ability to predict this stuff is not that great. Okay, and
No.
there's a lot of things that can happen. There's the war in the Ukraine is an unpredictable thing that was going on. The pandemic was completely, some people might have said it was eventually going to happen, but nobody knew exactly when. There's any number of things that can happen. I mean, there's the cost of energy, for example, that is continuing to increase. Capital investments in energy are reducing, particularly in the traditional oil and gas sector. So there's a lot of things that are not traditional changes in the input models to a lot of these economic models. So I don't want to put my business at risk based on some pundit's thought process. So I take a look at it as, okay, we're at an elevated risk of potentially seeing continued inflation, and cost related issues, maybe not even a recession. These things are all possibilities, and they're not trivial risks anymore. So as a result, I want to make sure that I have stabilized my portfolio. So I'm doing a few things so why am I refinancing all this stuff? People say, well, you're crazy. Why don't you wait 2 years, right? It'll be cheaper. You'll be able to get better leverage. You know what? If things get cheaper in 2 years, I can still get more of that capital, right? I'll just
Bingo.
do a refinance on the existing mortgage and expand that first mortgage, right? So that's a possibility. So I'm not leaving anything behind by doing this. But what I am doing is I'm building a reserve. So I'm building a large reserve that if things don't go the way that the pundits are predicting, I'm okay. I've got capital. I'm prepared in the event that I have, some loans maturing when things are really in, a high interest rate environment. I can still back everything up, and I've got cash. I've got some construction projects on the go, right? And I want to make sure I have cash in reserve for that, because as you know, when you're doing construction work, you rely on that refinance at the end of your project to pay out your construction loans. And you want to make sure that you're not stuck in a position where you can't pay that back. So I may end up with stuck equity, right, in that scenario, but at least I have capital to be able to do that. And quite frankly, if everything does go down the toilet, right, as some pundits are predicting, well, then there's all kinds of opportunities on the table.
On sale.
So exactly. So I don't have to, I can move the funds from being a hedge and a reserve contingency, if you will, towards more acquisition. So I didn't really see any downside of doing that. And in fact, to further hedge what I'm doing, this will be the first time that I'm actually looking at 10-year terms on my mortgages. And typically I'm running them on 5-year terms, thereabouts, plus or minus one. So this will be the first time that I do actually 10-year terms. And and that even is because I'm making sure that I have stability in those larger loans associated with those particular assets, so that no matter what happens to inflation over the next 10 years, I'm in pretty good position.
Well, and you have the money sitting there, and it's not like it was 2 years ago where a GIC was paying you 0.1%. I mean, I have a business GIC that's paying 4%. So you're actually probably earning a little bit of residual income while you're waiting to see what happens with the market.
Well, that's it, right? So, if you have that much capital sitting on the sidelines, inflation affects that too, right? It devalues the value of your capital while it's sitting there. So you do need to put it to work. So it's not just sitting there as a big lump of money. Some cases, I'll pay down some of my lines of credit, which, some of them are variable and they're expensive. And so it'll reduce that cost, improve my cash flow on that side. In other cases, it may go towards other types of short-term investments, including private lending. But the money's working, so it's not just sitting there, it's and depreciating.
I think a large part of just from watching you over the last 8 months since I've kind of known you, and I met you for the first time at the multifamily, not the multifamily, at Wealth Hacker back in November. So we actually managed to chat face to face. The fact that you are self-capitalized, this is a full-time job for you. You're generating enough cash flow. A lot of it would come down to analysis at the beginning. Now, my experience is, I can do these formulas all day long, say I'm going to get this cash on this multifamily. But then while Saskatoon gets hit with 20% vacancy, I turn over half my units, all my cash flow goes down the toilet. So that's kind of when I see a pro forma from a newbie, I see these, my exact cash on cash is going to be 5.27% in the first 3 years. But what you're doing, you're somehow managing to accurately predict. You're taking a lot of factors into play. You're also factoring in inflation and repositioning. So we'll get into the repositioning point in a second. But I want to go back to what you said about inflation and how that ties into your IRR formula. How do you figure out the internal rate of return? Because that's not a metric that I've really used myself. And is that something that every investor should be doing? And what's kind of maybe a simple way to explain that?
Yeah, it is. It's a key metric. IRR is one of those. It's a complex formula if you look at it, right? So just let Excel do all the heavy lifting for you. It's built in.
Google Excel IRR, and you come up with a formula.
And a lot of people misuse IRR, or they misunderstand what an IRR is. So sometimes people will confuse an annual rate of return as an IRR, and it's not. Or people will compare IRR values on different periods of time. And so it's a very common metric that's used by investors, by businesses. And whenever I've done business cases in the past, we always use that internal rate of return as a measure of whether this is the better business case than this other thing. And we also define what we call a hurdle rate. And that hurdle rate says that your IRR needs to be above this percentage, otherwise the business case is not worth doing. So to try and describe an IRR, in the simplest of forms, it is similar to an annual rate of return but adjusted for inflation. But it's a bit more than that. It's actually the sum of cash flows, right, adjusted for a discount rate. And what you're looking at is effectively that discount rate. So, and the metric has to be measured on the same period of time. So if you're comparing two investments and one is 5 years and the other is 5 years, and one has an IRR that's better than the other one, then you know which one to pick. But if you're comparing one that's at 5 years and another one that's at 3 years, the metric isn't going to be terribly meaningful. So it has to be used correctly. So at the easiest way I look at it is it is very similar to an annual ROI, but it's all measured on the cash flows. So for example, if you're doing a project and you're going negative cash flow for 2 years, you've got negative cash flow happening on your ROI, then you do a refinance event at the end or you sell it, you get a big influx of cash flow that gets added into the total amount. And then that's your actual rate of return. And again, adjusted for inflation. So what I found typically is that if you're doing at least a 30% IRR on a project over, say, a 5-year period of time, that when you do a refinance later on, you're almost always taking out all of your original working capital.
When you say you're 30%, that's what you're striving for. So when you look at a building, maybe you can reposition it, maybe you can add suites, you can convert, 3 bedrooms to 1 bedrooms, whatever it may be. The back end, you're looking at that 30%. If you can get that hurdle, then you can pretty much do a complete equity repatriation when you refinance.
Yeah, it's subject to a lot of conditions, but in a generally stable environment, that tends to work out. And I used to have a hurdle rate of 25%, but I just found that the business worked better if I had my criteria set at 30%. And in reality, a lot of the projects that we pick up have insane IRRs, like in the order of 60 to 80 or 90%. So when you see that in your analysis, you just look at it and go, well, that's easy decision. Guess we're doing that one.
Well, I got to ask you about deal flow, because I saw some of your case studies and they are amazing. Like this one that you talked about it was a mixed commercial. You had one commercial that you had a Class C tenant, and you had I believe it was 6 units. Yeah, 6 units, and then you had a separate house. So you had some tenants in there that were lower rents. But I also like what you said about you're not picking multifamilies that are full of seniors. You don't kick people out on the street. No. You find people that naturally transition, like the younger. So you factor that into your IRR and your analysis as well. Yeah. But that deal turned out amazingly well. And I think I don't have the exact numbers in front of me, but it was something like you had a 90% VTB. You ended up with a 22% cash on cash, 82% IRR, and 72,400 cash flow to operations at the end of the day, after everything is all said and done. Yeah. So, and you spent 9 months to negotiate this one deal. It's obviously worth your time.
Yeah, I negotiated it for 9 months, but all that money was made the 12 months after we closed on the deal. So
right.
That actually was faster than what my original business case was. But it was because we had good tenant turnover in that particular building. That was a relatively small project, but it's a good illustration of what we do. We have another portfolio that we bought last year that I've talked publicly about. That one's 27 units. In that one, we're just literally doing unit by unit conversions on that as the tenants move out. The vast majority of the tenants were in their 20s, early 30s. So that's a demographic that tends to move frequently. So
yeah, and it's important to note too, because you invest, I'm assuming you invest primarily in Ontario, where Ontario is subject to rent controls. You can't raise rents on people that are already in place.
No, and you can offer to buy people out, and you can terminate their leases if if you're doing renovations. There are stipulations associated with it, but in general, we try to run a very ethical business. So, which I've been surprised and disappointed to find out that's unusual.
It is unusual.
Yeah, but when we buy, if you're young, in your 20s, often people would be welcoming of a buyout, right? And I typically don't do that unless we're kind of in a pickle and we feel that we have to get it going because maybe there's a unit that's dependent on another unit, that kind of thing. Right. In which case we'll offer cash incentives. But let's say it's someone on social welfare. In Ontario, that would be on ODSP or OW, or it's seniors who have really, they just want a place now to rest and retire. They don't want to have to move again, etc. I can't do that to people. I can't force them out. It's just not the way I think. It's not the way that I choose to behave. So, and you were raising this earlier, right? Which is that if a property comes up and it's basically all filled with seniors, and the only way I'm going to make money is for those tenant turnovers to happen, I either have to wait them out, right, or do something that I don't want to do, which is to buy them out. So I tend to shy away from those. It's just not my thing at all.
Yeah, and you seem to be quite selective. Like, so the way I do with multifamilies, I kind of have levels of filters, right? I'll have like a basic formula I'll look at because I know certain areas. I'll look at, what does a loan look like? What does a DCR look like? What's the prevailing cap rate in the area? What's the lending looking like? And from that, I can probably eliminate, 95% of stuff that comes across my desk.
Right.
But in this case, this was a vendor who originally wanted, you ended up getting this for 850. I think they originally wanted 1.3. Most
I
people
think it
wouldn't
was,
spend that time.
yeah.
Most people wouldn't spend time on negotiating like that. So I don't imagine you have 10 of these deals that you're working on at the same time, because there's only so many hours in a day. Do you have a basic filtration with
Oh,
your
yes.
criteria for your business, or how do you approach deals?
Yeah, that particular deal looked interesting, but the guy had actually priced the property too high, and he was being a bit stubborn at first. So he just basically dissuaded every buyer that came past him till a point where, and I was persistent. So I would just follow up with him on a regular basis and say, George, why don't we have another discussion, see if we can find another way to get this done. And so we developed a relationship through that period of time. And then at one point, he actually came back to me because I told him at the time that I was willing to pay, not more than 800 for this, for that particular asset. And he said, oh, I can't do that. Right. It's, I've got too much money in it. And that was his issue, was he was kind of stuck with that. And I said, well, we reviewed all the numbers together, and he saw why I was offering 800 at the time. And at the end of the day, it came back as an unsolicited offer, and he came back to me at 825. Right. And then then we negotiated everything after that in about 45 minutes. Right.
Wow.
Yeah. So, the original realtor, we brought him back in, right, because we didn't want to cut a realtor out of this deal, right? It's how we got connected in the first place.
Right.
And the realtor helped out a bit, and I said, well, so George had gotten an offer from somebody else, and somebody then suddenly thought he was in demand again, right? So then he said, now it's 850. So so that's why I said, okay, well, why don't we put a VTD on there at 90% with a 4.5% interest rate instead of the original 6% that I was offering? And the realtor said, he won't do that. He loans money all day long at 12%. He's not going to take 4.5%. And I said, is he fixated on the price or the other terms? He said, oh, definitely the price. So ask him. So the realtor called me back 5 minutes later and says, he'll do it. Right. And so we got everything signed off in about 15 minutes at that point, just lock it all up. And at the end of the day, and I think this is worth pointing out, is, because the realtor asked me later on, he said, I thought you weren't going to take any more than 800 on this, or pay more than 800 on this. And he said, but you paid 850. And I said, that 1.5% discount that I took from 6 to 4.5%, do the math over 5 years, because that was the VTD term I took. That was $60,000.
Yeah, 60 grand.
He got his price and I got my price.
Oftentimes it comes down to terms. Most of the time it's price. It should be noted that you probably picked up this asset in a very hot Ontario market. I would assume the market was hot at the time.
No, so
No?
that particular, so the one that I picked up last year, so that larger portfolio that I picked up, that was picked up in a hot market, and that's another story. But that particular one, we tend to move into markets that we know or we believe are going to grow, and at some point in time. It's impossible to say whether it's 2 years from now or 10 years from now, but
Transition.
get an indication that it's really going to pop.
Yeah.
So we started buying into a town called Carleton Place, just outside of Ottawa, because as you talked about market research early on, it was at a crossroads, so it was kind of a hub town. It was just beyond the city of Ottawa boundary. City of Ottawa was really, putting a lot of back pressure on development. So, I could see that some of the developers were literally just going beyond the city boundary, right, and looking at the next set of towns. So I started buying into that particular town, and I would say, timing on that particular deal was outstanding, because that maybe not even a year later, right, the town really started to attract attention, and everybody was realizing they needed to buy in there. But by
So
that point,
that was a part of your due diligence. You kind of anticipated a wave. I know in Rain they talk about that. There's different, there's different metrics you can look like income and demographics. I hear a lot of people complain about Ontario. They're like, man, it's so expensive. I can't get a multifamily property. It's too much work. I'm going to look somewhere else. I mean, what do you say to that? I mean, obviously you're finding deals.
Yeah, and it's one of those things that at the beginning it's harder because you don't have a brand. They don't know who you are.
Yes. Yeah.
They don't know your financial resources. They don't know if you're a closer.
Sellers and realtors, basically your reputation in general.
That's exactly right. So what's the one thing that's going to happen if somebody Googles my name? And let's face it, my name is rather unique, right? In fact, I'm willing to put money that I am the only Christian Szpilfogel on the entire planet. But if somebody Googles me, they're going to see that I'm credible, that we're very active in real estate investing. So that's thing one. So that makes a difference. The other is I'll have realtors reach out to me, and sometimes sellers, right, to say, especially in the communities that we invest in, we're known quantity. City Hall knows us, the local landlords know us, and property owners know us, and the realtors know us. And so we have a reputation for closing. So if they offer me a deal and I say, subject to everything being what you said, right, I'm going to go ahead with it, they realize that I'm no nonsense. If I'm not interested, I'll tell them right away, not in our thing, right, done. So I don't waste their time, right? But if I say I am interested, they know I'm going to close. And so that makes a huge difference, especially with people who are commission based. They're looking at this like, who am I going to offer this to? Am I going to offer it to 5 people, of which some of them might close, might not close, and I'm going to put them in a competitive environment? Or am I going to offer it to Christian because if he says yes, this is going to get done, and that's an easy commission.
And for new people not to get discouraged, I mean, that process is exactly what I've done as well, in Alberta, and it just takes a while. I mean, you just have to do the right moves. You have to put offers on properties. You have to do what you say you're going to do, and it builds slowly over time. So I want to thank you for this interview. I mean, you give tremendous value. A lot of time you don't charge for it, as you said at the beginning. Elizabeth and I are going to be hosting Real Estate Resilience Part 2 in October of 23. And I don't know if she's reached out to you already, but we want to have you as a guest speaker on that as well. So we're really looking forward to that. And, what else are you up to? I understand maybe you're doing a bit of coaching. I don't think it's your full-time gig. I don't know if you're taking on clients. What are you busy with these days, Christian?
Well, for the most part, we're doing redevelopment work. So that's, we were talking earlier about how to increase value, and it's forced appreciation is really kind of our thing. So we're always looking for opportunities to increase the value of an asset. So we're building new cash flow streams and building new capital at the same time. I do some coaching. It's not our, we don't do it for the money. It's really, to be perfectly honest, it's inconsequential to the cash in our operations. But I feel it's important to give back and to help people. And so I'm typically taking on people who have some amount of experience, and I help them through their, streamlining their operations and, increasing their cash flow, figuring out where they can get more value out of their portfolio, and also helping with their processes, because often people are missing some gaps in the process. So I only take on about 4 or 5 people at a time. That's it, because otherwise it'll be a distraction of my business, and I want to make sure that I provide value to the people that I do have. So that's that. And then also there is the Ottawa Real Estate Investors Organization, where I'm on the board of that. Again, that's a nonprofit organization helping investors through, bringing in presenters, very credible presenters. Like we've even had Robert Kiyosaki present to the Ottawa Real Estate Investors Org. So they're good quality speakers. It's meant to be informative and educational, and also a good networking event. So anybody certainly in the Eastern Ontario region are very welcome. It's we have a very modest fee, and it's just to pay for our expenses. The board is all volunteers. So that's again part of my.
People get a hold of you, Christian, and how do people find this group? Like, can they go to your website, aliferous.ca, or is there a separate link for this networking?
Yeah, aliferous.ca is certainly my domain, but Oreo is oreio.org, right? So Ottawa Real Estate Investor Organization.org. And people can get information there. If they reach out to me through social media, email, whatever, I'll certainly point you in the right direction.
Fabulous. And just kind of the last question I had is, we've talked a lot about repositioning. We didn't get into it as much as I wanted to, but would you say that's like every property you get is a reposition play? Do you ever see a perfect property and it's just like, I'm just going to buy and hold and do nothing to this? Or is everything reposition?
No, the only reason I would do that is if there was a land banking component, but everything that we buy has a business case element. So we're always looking at a project that, I have a saying, it's either cash flows on acquisition or have line of sight to cash flow.
Line of sight to cash flow.
Yeah.
Love it. Love it, Christian. Well, we're out of time here, so I'm going to have to leave it there for now. I feel like we need to do a part 2 on this interview, but again, I really want to thank you for your time. I know you're a super busy guy, and my audience is going to love this one. So again, I really appreciate it.
Corey, this was a lot of fun, and I can't believe how much time already flew by. It felt like 5 minutes to me.
Yeah, we're both kind of real estate nerds, so it's easy.
Yeah, that's right.
Okay, my friend, we'll see you on the next one.
Great. Thanks, Corey. Take care.
Yeah.